All right, perfect. Yeah, so obviously we've been spending a lot of time talking about CLV, and we've seen some adoption from a growing number of companies, but oftentimes when it's being used by a few people in the data science department, and it really hasn't taken on the life that it should. Really, it should be something that should be driving most all of the different functions of a business, all the way up to kind of setting high level strategy, by the CEO and CFO. And I think that's really the opportunity is, we need to see a lot more of that. And I think we're finally at the point where it's coming of age, and we're seeing maturation to the point that we're seeing kind of broad-based buy-in, both by executives and by the investors that they are reporting to. And so that's really what I think is the big next opportunity. Um, my perspective on this topic comes from wearing a few different hats. The first hat is as a marketing professor. So I am formerly a statistician by training. My PhD is in statistics. Um, I teach a course called Customer Lifetime Valuations. So literally, my course is CLV. Um, the other kind of couple of hats that I've worn are entrepreneurial in nature. So I had co-founded a business with Wharton professor Peter Fader, who many of you probably know. You talk about customer centricity. He wrote the book called Customer Centricity. We co-founded Zodiac. We kind of ran our predictive models, best-in-class models, typically on behalf of marketing departments, and we would use them to help marketers make better tactical customer acquisition and retention decisions. We grew the company very quickly, and then we sold it to Nike in March of 2018. And again, very interesting when we think about CLV coming of age. Here we have a company that, they're hoping in 2025 to have 50% of their business coming from direct channels like their website and stores, but the other 50% will still be coming from indirect relationships. And so here we have this company that ostensibly would not have been in the perfect sweet spot for this sort of modeling, and they're kind of opening up the checkbook to really kind of take CLV in-house. So we sold it. We took some of the proceeds, this is Pete Fader and I, and we then co-founded a second business called Theta, which has primarily been using the same sort of models, but using them on behalf of private equity firms. So right now, about 50% of our business is coming from corporate, very similar to the Zodiac use cases now. But the other 50% is coming from private equity firms that are using CLV to inform their investment decisions. Do we want to buy this company or not, based on the unit economics that we see evident through the transaction log data? And that's really, I think, what's bringing this to some extent into the C-suite, is that the investors are now asking them a whole bunch of questions about, what is your retention? Why is it different across these segments, et cetera, et cetera. So again, I think broadly speaking, when we think about it from the C-suite's perspective, a big question is, are we really creating value? And there's kind of two diametrically opposing viewpoints as to how we measure that value. The first is the Warren Buffett approach. Strictly speaking, a firm is creating value if its return on invested capital is greater than the cost that's being demanded of it by the investors. And that's a pretty rigid and hard threshold to meet. Not a whole lot of companies necessarily, especially early on in their life, are profitable on an overall company basis. The other viewpoint is just kind of like the VC viewpoint. It's kind of just, let's just grow this thing, grow it real quick, and we'll figure out the whole profitability thing at some point later on down the line. And there's just a number of examples of companies that have done a great job of growing, but have not created any value, and have subsequently ended up going bankrupt or have been struggling significantly. Now, the second level question, which I put as a sub-bullet, is, even if you're creating value, there's this question, am I creating value optimally? Am I making the best decisions that I can? And I think to be able to answer both these questions, CLV is really the way to go. And it's kind of somewhere in the middle between those two extremes that I showed. So what companies need is, if they're not profitable, they need the path to profitability and to move along that path as quickly as they can. And I think it motivates a focus not necessarily on the Warren Buffett absolute profitability, but on incremental profitability. When I acquire that next customer, am I turning a profit? That's really what CLV is supposed to be measuring. And I don't need to turn a profit today necessarily. I want to if I can, but if I can't, that's not necessarily a bad thing if the net present value of the profit that I get from that customer is really high. And so I want to take into account not only the profit I get when I first acquire a customer, but also all the profit I'm going to get when that customer makes repeat purchases in the future. I want to find a whole bunch of investments that have very high incremental return on investment. I want to invest in them over time. And if I can find enough of them, I'm going to become profitable. That is the path to profitability. Now, the only third thing I mentioned here is you're going to want to also manage your overhead. So again, I could spend a lot more time on each of these bullets, but I'm going to be spending more time really on the first bullet here. So obviously, this is no, I'm preaching to the choir here, but the metrics that we need to be able to identify those investments are metrics at the customer level. And how do we find more of them? We need to enrich the transaction log data with other touch point data, especially behavioral, so we can know what people are looking at, what they're buying, what they're not buying, and then instrumentation to be able to start to understand the causal relationship between actions that we take and the downstream effects on things like customer value. So again, a lot of my perspective has now been informed by just the notion of how are we creating value? And so it helps to take a step back and say, well, what is value? And if we think about shareholder value, and you just kind of open up a standard corporate valuation textbook, it's going to break it down into three pieces: operating assets, non-operating assets, and net debt. The most important one is the operating assets. This is everything that drives revenue and has those revenue streams flowing through into profit. And people talk about how it's being driven by product, it's being driven by the strength of the brand, technology, IP assets that they might have, distribution, the effectiveness of the sales force, talent acquisition, et cetera, et cetera, et cetera. And that's all true. But the fundamental claim that I'd make as a customer-based corporate valuation advocate is that underlying every single dollar of revenue is the customer making a purchase. And most of the time, if you're speaking with someone on the investor side, they'll understand that intuitively, but they don't spend any time on the transaction log. And there's just all this juicy information that we can get from it that can inform how a company's doing. And then on the flip side, the executives of the firm can use the same information first to be able to communicate effectively with those investors, but then also, to be able to manage their business better. Now, the reason that this has always kind of been true, but it's even more relevant today for a handful of reasons. First, there's just a hyperabundance of customer level data. So all that transaction CRM data is abundant in a way that it hadn't been before. We have a wider range of motion in terms of the actions that we can take to target certain customers versus others. There's just a fundamentally wide variation in customer value. So at Zodiac, we probably ran the models on 250 companies. We've run them on probably 120 at Theta so far. And time again, what we'll find is that most B2C firms, 40 to 80% of the customers make one purchase and never come back. And so when you take into account, variable costs and customer acquisition costs, most firms are losing money on 40 to 80% of their customers. And they're making back the money for the cohort on this very small, 5-10% of their customers. And so wouldn't you want to know what it is that makes that 5-10% so different from the others? And then finally, again, this is me being the statistician and the professor, we just have a lot more computing power and algorithmic insight than we ever did before. So it's just made it a lot easier for companies large and small to be able to run the numbers. And so again, I mentioned customer-based corporate valuation a few times. CBCV, what it does is it explicitly ties the value of a company to all the sort of stuff that we know and love, customer retention, customer adoption, order frequency, and then ultimately, customer lifetime value. And the way that it does it is by kind of doing valuation the way that a finance professional would think about it, but kind of driving revenue and other key expense line items off of customer measures, customer behaviors. So the first thing we're going to do is we're going to forecast customer adoption and customer churn. And if I knew those two things, if I knew how many customers I'm going to acquire over time and how long they're going to stay, I'm going to know how many customers I have. And if I know how many purchases they're going to make and how much they spend on those purchases, then it's an accounting identity that has to get us revenue. And then really, pretty much everything else flows through in the same way that it normally would for a traditional DCF valuation model. The only kind of additional insight that we glean is obviously to get CLV, we need some notion of a contribution margin. And so that gets us to contribution profitability. And if we knew how much the company's going to spend on customer acquisition costs, that gives us insight into what marketing expense is going to be. But again, everything else, standard valuation. So the key that we're going to do is we're going to use kind of best-in-class models, the sort of models that we'd use at Theta, to forecast future customer adoption, retention, ordering, and spend. And if we have that, we can get a more accurate estimate of revenue for those finance professionals. And on the back end, we get all these insights into things like CLV and post-acquisition value. So you just wanted to be clear, I think probably 75% of the time there are disagreements over CLV. A lot of them are definitional. Yeah, I think that people have different ideas in mind as to what CLV is. So just to be clear, when I say CLV, what I mean is the net present value of all of the variable profit, not all the revenue, but all the profit associated with the customer, as well as all the costs, inclusive of customer acquisition cost. Now, post-acquisition value, I'd say, is the value of a customer after acquisition. So don't take into account customer acquisition costs. How much profit am I getting from everything else? And again, these are the metrics that determine the long-term return on investment. Essentially, customer acquisition cost is the investment, and post-acquisition value is the return on that investment. It's the value of the investment after the investment. So post-acquisition value, what does it tell you? What it tells you is this is what I'm getting after I acquire a customer. So if I know I'm getting $100 on a customer after acquisition, I don't want to spend more than, I certainly don't want to spend more than 100, right? Because then I'm not making any variable profit in my business. But truly, if you're a B2C firm with a big market, you probably don't want to be spending more than 33, maybe upwards to 50 to bring in customers. Or else I'm not kind of getting enough incremental profitability to cover all the overhead that I still need to incur to be able to get this whole customer acquisition engine running in the first place. Now, CLV, what it's telling us is whether I'm upside down or not. So again, this is a chart from a diligence that we've done earlier. And what it's showing us is post-acquisition value, those are the blue bars, and then customer acquisition costs, those are the purple bars, for a whole bunch of different acquisition cohorts. And we can see is there's a nice gap between the two. Is it exactly where we'd want it to be? Probably not. We'd love for the return to be a little bit higher, but the return's not bad. So again, when we think about that path to profitability, what do we need? We need three things. The first is current unit economics are good. We need a sufficient number of customers that we then acquire into the future, and we need that without significant degradation of those economics. And so if we have those three things, then we'll be right on the path. So that's the goal. And there's a lot of companies, if they don't have good economics today, what they're going to say is, well, our economics are going to be good in the future. And, possible. But there's just many examples of companies who have tried to pitch that, and it hasn't happened. And there's a lot of reasons why it can be hard to realize that. So again, there's just a whole bunch of other measures that I think are important, oftentimes are confused with CLV. Just the other day, I was reading someone who was saying how CLV is the sum of the revenue of customers. And good measure, but ick, that's certainly not CLV. Finite horizon measures are very common. The notion of a payback period is very common in project finance. And I think it's just as relevant in customer businesses. It's basically the time it takes to get your money back. So you spend money to acquire a customer. How long is it until your contribution profit exceeds CAC? And again, that's just a good thing to know. And there's a growing number of companies like Revolve Clothing in their pre-IPO prospectus that are disclosing it explicitly. They're saying here, we spend $30 to acquire customers, and just on that very first order, we're getting $43 of contribution profit. So we're making money on day one. Now, I'm not saying that you need to be first purchase profitable, but if you can do it, that's good. And it's certainly something to have on your report card. So in the same way that I think that, in the same way that little Johnny is going to have a report card with English and math, I think there should be an additional thing on that report card for unit economics. And the sad part is I think 80% of companies have no idea what their grade is. And so, we really need to understand that. Are you getting an A or getting a C? And until you run the numbers, you won't know. So it's very hard to know where you should be going if you don't even know where you are right now. Now, a big key is we need to be able to measure these quantities properly. So first step is getting the right definitions, but the second step is uh, predicting it well, and that's really hard. I'm a PhD statistician, and I'll be the first to say this is a very hard prediction problem, especially for some businesses, especially when we try to forecast out a bit further, and especially for the young cohorts that we have very little observable transactional behavior for. So basically, there's kind of three things that we need. The first thing is we need the right data. Bottom line, bare minimum, we need kind of transaction log data or summaries thereof. And then the more we can enrich it, the better. So again, basic first step is customer ID, date, and spend. But then second level, we need ideally kind of, if we could get it, transaction level profitability, any other events that might be happening over time. Fulfillment expense is something that often is known at the overall company level, but not necessarily at the transaction level. And just all sorts of other information like that. If you can be able to tie customer feedback and service request data to the customer IDs in your transaction log, then you can try to understand the relationship between those two things as well. And so there's work involved to be able to make that happen. So this is a company that helps kind of tie these different data sources together so you get a more unified view of customer lifetime value. Second thing you need, again, is the right definitions. But then the third is you need the right predictive model. So yeah, it's not easy. I wish I could say that it was. And a lot of the marketing science literature, it's really taken us very far. But we have found over the course of the 350 plus diligences that we've done that there's just a handful of other dynamics that are often present that you need to account for. And if you don't, your predictions are just not going to be good. So again, when we think about the definition of post-acquisition value, really what we need is we need the net present value of the number of orders that we get, the revenue that we get from those orders, and the contribution margin from that revenue. And if we can have models for those three things, then as long as we account for the time value of money properly, that's what gets us post-acquisition value. Now, when we think about the definition of contribution margin, I think there is a lot of misunderstanding about it. This should be accounting for all of the costs that are tied to specific orders. So direct labor, direct materials, payment processing fees, shipping, fulfillment, and then really all of that effectively variable overhead that kind of comes with every single order. I spent a whole lecture actually just on Wednesday on what customer acquisition cost is. You could spend an entire semester on customer acquisition costs, but suffice it to say, it should be all the costs associated with acquisition. So acquisition related marketing, acquisition related sales, and then even on the back end, things like client onboarding, because client onboarding, you're going to spend it after acquisition. So it's caused by the acquisition, but typically most of it then goes away after that. And so it is truly a cost of acquisition that doesn't show up afterwards. So I would include that too. How do we do the predictive modeling? For one, it depends on the business model. The other, it depends on the nature of the data. So in terms of business model, if it's a subscription business, tends to be a lot easier. So we have the ability to observe when customers churn. We know how many customers we have at any given point in time. And so we can specify a richer model for customer retention. Purchasing tends to be much smoother. I mean, at most subscription businesses, there almost is no notion of a purchase. You just kind of buy once a month. And the amount of spend also tends to be pretty well behaved. And so this is more like shooting fish in a barrel. The harder setting is non-subscription. Most, 80% of discretionary businesses are non-subscription. And again, the things that make it harder is that it's kind of the inverse of a subscription business. We don't observe when customers churn. We just have to infer it from the purchase behavior. And then both purchasing and spend tends to be a lot more variable across the customers. Now, the good thing is there are time-tested models that do very well. And especially if you further enhance these models, you can do even better. And so we have the ability to estimate CLV pretty accurately in non-subscription settings. Now, again, there's all sorts of other variations on this. There's businesses that are kind of hybrids of the two. And again, these are why it really helps to bring in specialists. Again, that's why I co-founded Theta, to be able to kind of make, to kind of handle all those situations that that might have a little bit of hair on them too. You can still run these models. It just takes a little bit more work. Now, the next distinction is, what is our data? So if we have internal transactional data, great. The richer, the better. If we had every single purchase that's happened all the way back to the beginning of commercial operations, we can specify a nice, rich model. And that's the setting that we primarily operated in at Zodiac. So we would, again, as a SaaS firm, we'd programmatically ingest all the transactional data from the companies that we work with, and then we would spit back out things like, what the breakdown of CLV is. So after we sold it, we then started Theta, and at Theta, it's been a mix. So we've been actually surprised how many times private equity firms will get companies to put the full transaction log into the data room. But even when they don't, even if they just give us these cohort triangles that say, for each of these monthly acquisition cohorts, this is how many active customers we had, how many orders we had placed, how much revenue we got. That sort of data, it's fine. We can still be able to run the models on that. So yes, again, this setting, it involves not only the granular data, but also sometimes kind of aggregated summaries of it. And so, obviously, if we're doing work on a public company and we don't have any inside baseball, then we kind of have to run with what we can find through SEC filings. And that's going to be about as rolled up as you're going to get. And then usually in private equity, it's kind of somewhere in the middle. So again, there is kind of a minimum threshold below which we're not going to have the certainty that we need to have confidence in our model. But that bar is relatively low. And so in every other circumstance, we should be in good shape. So again, I've talked about SEC data. The other thing that we'll often see is data coming from alternative data providers, Earnest Research being one of them. So if you haven't worked with them, give them a look. They have really nice insight into the granular purchase behavior of 2 million people. You can think of them as having the full credit card statement for those 2 million people over a period of 7 years. It's a very long period of time. And they have something like 3,500 companies that are tagged in their data set. So that's about measurement. Now the question then is, well, what about management? So I can see what you mean about being able to use this stuff to communicate with my external stakeholders, but how do I use this to optimize my value? And so you've gotten your report card. Maybe you got an A, and the question is, how do you move from an A to an A plus? And that's where we need to start thinking about the actions that we can take. And so one thing that we'll often do when we're working with corporate clients, actually it's typically the first thing that we'll do, is we'll get kind of implied marketing return on investment, which is CLV to CAC, by acquisition channel. So it could be, Google, Facebook. I've got over here, and this was from a diligence that we had done, streaming, et cetera, et cetera. And over here, the blue bars represent the contribution post-acquisition value of customers. The orange bars represent customer acquisition costs. And so when the orange bar is greater than the blue bar, that means that the implied marketing return on investment is negative. And what we can see here is that Facebook actually was not profitable for this business. They did not get back their acquisition costs on subsequent purchases. And so that was a problem. So, we actually had recommended to this business that they may want to consider reallocating budget away from Facebook, maybe towards streaming. So again, it's very hard to read too much into this. But yeah, for a downstream channel like Facebook that's right at the bottom of the funnel, I think it's safe to say that is not a productive channel for this company, at least relative to Google. We'll also run this same sort of analysis across other customer subsegments. And so one of them could be, did you make your first purchase in a store? Did you make your first purchase online? And what we'll see time and time again is that customers that adopted into a firm through a store tend to be much more profitable. And this was just kind of an example of that. We can see in blue over here, the post-acquisition value by acquisition cohort for in-store customers, whereas it's kind of like a wine red. That's the trend for the online customers. And we can just see not only a gap between them, but that the gap is growing over time. You want to also then be able to, you want to invest in experimentation. So again, the reason I didn't have total conviction with this chart in the top right is because this is, kind of an average performance. It's not necessarily a causal relationship that we're identifying. And so if you really want to establish causality, yeah, it helps to be able to run experiments. Now, companies like Netflix have done a good job of this. Obviously, the system that they're using is pretty expensive, but there's other systems that are available that are cheaper, like Optimizely. And at the very minimum, you could consider running regional, again, it depends on the business, but something like a regional suppression test, where you just drop down your spending in a certain channel in a certain geography to a very low level or even zero, and see what effect that it has. And then finally, establishing direct customer relationships. This is another very important thing. Again, this is what Nike had done. And what it helps them with is not only do they kind of get to pocket more margin, they don't have to pay a middleman anymore, but they also get to learn about their customers a bit more. So obviously, companies like Nike, they can still use third-party data sets to get some insight into household level purchasing behavior over time, but it's kind of an indirect proxy. And there's just no better way of understanding customer preferences than to actually sell directly to them. And you learn a lot more. So in terms of the takeaways for you, step number one, you really need to get your data house in order. If you don't have the right data, you won't be able to get started, even if you fully want to. You kind of move along this path towards customer centricity. And so step number one is just getting that nice clean transaction log. It's surprisingly hard sometimes to get that. Sometimes you migrate from one data set to another, like migrating to Shopify 2 years ago. And just kind of, what do you do with all that old data? How can you kind of connect the two data sets together? That sort of a thing. And then level two would be connecting it with all of the other data sources that I mentioned before. The second step is sound customer measurement practices. So getting those right definitions together and getting the right predictive models in place. And once you've got that, then you can put together that customer-based report card that I mentioned. And it should have all these different quantities on it by acquisition cohort, by different segment. And then you need to invest in experimentation to really be able to take the results that you get from that report card and understand, which of those relationships might imply causal relationships that may suggest things that your business should change. And then you want to instrument yourself for action. So you want as wide a range of motion as you can. If you can't take action, then this is still useful, but it's more useful for reporting purposes. But again, instrumentation is what allows you to take more targeted actions, which allows you to create more value over time. And then just kind of finally, you can kind of repeat this over and over again. So you take those actions, you reallocate the marketing budget, you update your forecast for the next period, and then just kind of rinse and repeat over time. You don't need to be perfect on the first shot, but assuming that you get better and better over time, then you'll get where you need to be. So yes, that's pretty much all that I've got. If you want additional resources, I'd love to hear from you. Connect with me on LinkedIn and Twitter. I'm talking about this sort of stuff all the time. Email me, and I've got a handful of other links here. Check us out at Theta if you think this might be interesting for your business. But yeah, that's pretty much all that I've got.